How do ECB refinancing operations impact inflation? Imagine a central bank as the engine that keeps the economy running smoothly. The European Central Bank is that engine for the Eurozone, using tools to control how fast or slow prices rise. One of its main tools is refinancing operations. These are like loans that banks can take from the ECB to get cash to lend to businesses and people. The ECB offers these loans at a set interest rate, and banks usually provide collateral like government bonds to secure the loan. There are two main types: the main refinancing operations, which are short-term, and the targeted longer-term refinancing operations, which last longer and sometimes have special rules. When the ECB wants to boost the economy, it can make refinancing more attractive. It does this by lowering the interest rate or offering more funds. Cheaper borrowing means banks can lend more money to businesses and consumers. When people and companies borrow more, they spend and invest more. This increased demand can push prices higher if supply doesn't keep up. So, in this way, the ECB's refinancing operations can lead to higher inflation, especially when the economy has room to grow. On the flip side, if the ECB worries that inflation is rising too fast, it can make refinancing more expensive or limit how much money banks can borrow. This makes borrowing less appealing, so banks lend less. With less money circulating, spending and investment slow down. This cooling effect can help bring inflation back down if prices are rising too quickly. The ECB's main goal is to keep inflation close to 2% over time. Refinancing operations are part of a bigger toolkit that includes setting interest rates and buying assets. These tools work together to steer inflation toward the target. When inflation is below 2%, the ECB might lower refinancing rates or increase the funds available to encourage more lending. If inflation is above the target, it can do the opposite to slow things down. The impact of refinancing operations depends on the overall economic situation. If interest rates are already very low, further cuts might have limited effect. The ECB also watches inflation expectations and global economic trends to decide how to adjust these operations. It communicates its plans clearly to influence what people and banks expect about future inflation and borrowing costs. In recent years, these refinancing operations have played a key role in supporting the economy during times of uncertainty. They help ensure banks keep lending, which supports economic activity and can prevent deflation. But if the economy is already at full capacity, more lending might cause prices to rise faster without increasing output much. It's important to remember that refinancing operations do not work alone. Their effect on inflation also depends on government policies, global economic conditions, and other factors. The ECB constantly monitors a wide range of data to decide how to adjust its tools and keep inflation stable. In the end, these operations are a way for the ECB to influence how much money flows through the economy, which in turn affects prices and inflation over time.